Investing in oil and gas drilling might not be the first thing that comes to mind when you think of diversifying your portfolio, but this sector offers significant tax savings for high bracket taxpayers. Hi, I'm Ginger Chan, founder of WealthQuant. We work as financial and tax strategists, and our focus is on education, modeling, and strategic design, helping clients connect income planning, investment considerations, and tax planning into one cohesive system instead of treating each decision in isolation. In this session, I'll dive into the world of oil and gas drilling investments and explore how they work, the tax benefits, and the associated risk and limitations. So keep in mind, this session is for educational purposes only. Nothing discussed here is tax, legal, or investment advice. At WealthQuant, we do not provide tax or investment advice. We design and evaluate strategies, perform modeling and analysis, and we coordinate with licensed professionals such as CPAs and attorneys for verification and execution. So oil and gas well investments allow investors to put their money into the production and development of oil and gas wells. It's kind of like a hybrid between a tax play and a traditional investment, whereas solar is mostly about the tax savings. If you put in money into solar, about 2/3 of the return comes from tax savings and about 1/3 comes from the revenue over the years. For oil and gas investments, it's more heavily weighed toward the investment side as it offers potential high returns. So let's dive into the key benefits of oil and gas investments first. The number one that people look into oil and gas investments most likely is because of tax savings, because every dollar put into oil and gas investments get you a deduction that's greater than 90% of the original investment in year one. For example, if you invest 100K, you get to deduct over 90K off of your capital gains or ordinary income in year one. The actual tax savings is dependent on your marginal tax rate, which can likely be anywhere between 30 to 50%. So in a 100K investment will give you anywhere from 30 to 50K in tax savings in your first year. One point I want to clarify is that these are actual oil and gas projects and not investing in publicly traded oil and gas stocks. The number two benefit, which in my mind is the bigger benefit, is the investment returns that it offers. So these oil and gas funds, they invest in portfolios of oil and gas wells that have historically shown returns between 10 to 20% per year. And with higher returns in the earlier years compared to later years, as wells do dry up over the course of years. Historically, these investments got their original principal back in about 5 years or less. If you combine the tax savings and investment returns, and these projects typically have more than 20 years of useful life or cash flow. The nice thing is that there is a floor on the return, which is the tax savings that you get right away in year one. So if your tax savings is 50K, then you lock in 50K as the floor in this investment. And the rest of the investment comes from the investment returns from the cash flow from these oil and gas wells. Other benefits of investing in oil and gas is that the income from the investment, although it's taxable, only 85% of the income will be taxed, and 15% of the income is tax deductible. The number two benefit is that there's really no material participation requirements, and therefore you don't need to set up an entity to participate. So it doesn't matter what time of the year you invested, you will be able to take deduction of the full deduction available for that year, even if you got into the project, let's say in November or December. One note that I want to emphasize is that the depreciation can only be carried forward and not backward. So again, if you don't have oil and gas investments in your portfolio, this is a good way to diversify your portfolio, as oil and gas is typically not directly correlated with the broader market with only a 35% correlation. We talked about the benefits of oil and gas well investments. There are also risks involved. The primary risk really is dry or underperforming wells. For dry wells, there's always a chance that the well doesn't produce enough oil or gas to be profitable. Although that risk has dropped a lot over the years because technology has improved, which I'll touch on later. But back in the early 2000s, traditional vertical wells only hit commercial viable oil about 60% of the time. So almost half the time it comes up short. But today, with horizontal drilling and better geological mapping and smarter analytics, the current success rates are closer to 85%. So these funds usually drill multiple wells in a single project. So the result of one well doesn't really make or break the investment. Another risk is that you can have unexpectedly low revenue. And the reason for that is because your returns are actually tied to how much oil gets produced from that project and also what the market price is for oil. So because prices can swing sometimes a lot, the it does affect the returns. However, the good news is that most oil and gas funds use hedging strategies to help smooth out the impact of the big price drops in the short term. And the last but not least is the general partner liability. So in the first year, typically you're considered active so that you can take the majority of the depreciation. So, but because you're treated as active, you're treated like a general partner, which means that there is a potential liability risk if something goes wrong during drilling. The fact is, though, that these funds do carry a large insurance policy or large insurance policies to protect investors. So after the first year, most investors shift to passive status, which then significantly reduces this risk after year one. So how exactly do you get tax benefits from these oil and gas investments? Well, oil and gas projects have operating costs. And as an investor in an oil and gas drilling project, you can actually deduct those operating costs as depreciation. So oil and gas projects generate two types of depreciation: intangible drilling costs, or IDCs, and tangible drilling costs. Intangible drilling costs include labor, fuel, and chemicals. And that distinction matters because you can actually deduct all of intangible drilling costs in your first year of an investment. In other words, if you're taxed at a 50% marginal tax rate between federal and state tax savings, you will recoup about 45%. So let's say 90% IDC depreciation times 50% tax rate of your investment in the first year from just tax savings alone. If you invest 100K, but have 90K in intangible drilling costs, you can deduct that 90K from your salary, capital gains, or business income on your taxes that very first year. The remaining tangible costs are like equipment and pipes that they will get deducted over a course of 7 years. Tangible drilling costs include the cost of drill bits, the drilling rig, and the casings, and about 90% of drilling costs are intangible and about 10% are tangible. So IDCs work the same for everyone at the federal level and in most states. However, there are a few states that do not fully conform to the federal tax treatment regarding IDCs. So in these states, the deduction for depreciation applies differently for state income tax purposes. If you are in California, Pennsylvania, New Jersey, Massachusetts, and North Carolina, you'll need to refer to the following table to see what the state income tax treatment looks like. So I want to talk more about depreciation. The tax code differentiates between active and passive activities. When you have depreciation from an active activity, you can actually use that depreciation to offset any income, including W-2 income. But when you have depreciation from a passive activity, you can only use that to depreciate or offset passive income, like income from a rental property or a private equity investment. So what makes oil and gas well investments so powerful is that they are considered active, which means their depreciation can be used to offset W-2 income or other business income. And yet, even though they're considered active, they do not require material participation. So this is pretty significant because in most contexts, whether someone is considered active or passive depends on the extent to which that person materially participates in the activity. For example, if you invest in real estate and you want to take bonus depreciation, you may have to spend at least 750 hours per year in order to be deemed active. at that point, it's a full-time job. And so the barrier for material participation is slightly less for solo projects. It's 100 hours per year. But for oil and gas projects, there are actually no material participation requirements at all. So it doesn't matter how involved you are, your investment can be treated as active. However, in practice, as I mentioned previously on the risk of general partnership liability, the oil and gas fund will deem you to be either an active investor or a passive investor. Typically, investors are deemed active during the very first year of an investment when the majority of the depreciation is taken, so that they can use the depreciation to offset the other incomes. But after the very first year, once a vast majority of that depreciation has been taken, investors are deemed to be passive to limit their potential liability in the event that the oil and gas project is subject to a lawsuit. Another thing about oil and gas investments, the perks of it is that these investments comes with a big tax perk, which is called mineral interest depletion. If you earn income from an oil or gas well, you can actually deduct 15% of that production income from your taxable income. If you make $10,000 from the oil and gas wells, you're only taxed on $8,500. The other $1,500 is essentially tax-free for you. And to use this benefit, you just need to qualify as a small producer, which just means that there are limits on how much oil you can produce each year. And the good news is most well-structured oil and gas deals that bring in individual investors are already set up to meet those rules. So you don't have to worry about that. There are some tax savings limitations I also want to discuss, which it's important to know. One is the alternative minimum tax requirement. The AMT is basically a backup tax system that kicks in if your regular taxes drop too low after deductions. And with oil and gas investments, there's a limit on how much of your intangible drilling cost deductions you can actually use each year under AMT rules. So you generally can't deduct more than 40% of your alternative minimum taxable income. So the bottom line is that you can still benefit, but the AMT may cap how much tax deduction you can get to use in a single year. And this is why it's so important to coordinate with CPAs, either yours or through WealthQuant, so you know the maximum depreciation you can realistically take. And then the next one that you have to be aware of is something called the excess business loss limitations. This rule, which limits how much business loss you can use to offset things like salary or investment income. In simple terms, you can't use unlimited losses to wipe out all of your non-business income. And for 2025, the cap is $313,000 for individuals or $626,000 for married couples filing jointly. Let's say, for example, if a married couple makes $1 million in W-2 income and has $627,000 in depreciation from an oil and gas investment, only $626,000 of that counts this year. The extra $1,000 gets carried forward to the next year. However, if that $1 million of income came from a business like in C Corp, then this rule generally would. So that's all cool. But why do we talk about oil and gas investments as an alternative investment? Well, oil and gas well investments have taken off in recent years, and there's a clear reason why. Technology actually changed the game. So producers now can pull out a lot more oil, doing much cheaper than before. And the best example is the Permian Basin in West Texas and Eastern New Mexico. The basin is huge. It's around 86,000 square miles, and it's become the heart of U.S. oil production. Back in 2010, the U.S. was producing about 5.5 million barrels of oil per day. But fast forward to 2023, production more than doubled to over 12 million barrels a day. And the Permian alone pumped out more than 5.6 million barrels per day, which is about 40% of everything that's produced in this country. And a big part of this boom comes from the technological advance of horizontal drilling. Old school wells drilled straight down, which limited how much oil they could actually reach. And horizontal drilling lets companies drill down, then sideways for miles, hitting multiple layers of oil-rich rock from one well. And in the Permian, wells can stretch anywhere up to 2 miles horizontally. And that's why a modern horizontal well can produce over 1 million barrels in its lifetime, compared to just 150K to 200K barrels from a traditional vertical well. So basically what this means is you get 5 to 6 times more oil compared to before. And also recently years fracking took that even further. By pumping water, sand, and chemicals into the rock at high pressure, companies can open up tiny fractures that let oil and gas flow much more freely. And that's what makes these wells so productive and cost effective at this point. If you just look at the costs comparing in 2014, most shale producers need an oil price to be above $60 per barrel just to break even. But thanks to all these newer technologies and more efficient ways of drilling for these wells, many premium producers in 2023 could break even around $30 per barrel. And actually, some of the best operators can even make money at $25. In conclusion, investing in oil and gas wells comes with powerful tax advantages that can be especially valuable for high income earners. And when they're structured correctly, these investments can significantly reduce your tax burden while also helping you diversify your portfolio. The key is really understanding how the tax benefits work and how to take advantage of them the right way. So if you want help evaluating whether the strategy makes sense for you, our team at WealthQuant can walk you through the details, the risk, and the tax impact so you can make a confident decision. Thanks.